So you mentioned trading to the downside. And it's interesting because what you just said, I feel like is what I'm doing too. I feel like my automated stuff is more to the long side. Is that maybe what you're implying, that
Uh-huh.
your automated trades are to the long side
Yep.
and we're really just trying to hedge the downside? Now, is that because, um, you know, do you buy in? Is it just because the markets usually goes up more than the downside, or like, what's your take on that? Because I know what I tell my members is I have a lot of bullish strategies and different time frames and things, and I get asked all the time, well, can you just flip the indicator and take it to the downside? Can you do the opposite? And when I back tested, the answer is no.
Mm-hmm.
You can't. It doesn't work like that.
Right.
And so my take is like, well, I just feel like every market decline is sort of unique, whether it's, a couple days, a couple weeks, or you end up with like 2022, which was like a quote unquote real bear market. But then you ended up with 2020, which was technically a bear market, but only lasted a month. And
Right.
so you can't just backtest bear market stuff. So what's your take on, you know, I guess having a mix of automated strategies, or are you just kind of mostly long and you're discretionary short, or what are your thoughts on that?
Yeah, it's definitely a mix. I mean, the long approach still requires that there's a long-term trend. Otherwise, it's back in cash again. So if we start to break key support levels on many of the strategies that I've built, then it's going to exit straight to cash, and now we're effectively market neutral, just waiting for a base again before we start entering back into a long-term trend. I think we've had the benefit of a really long market upcycle for roughly 12 or 14 years now, since the Great Recession or the GFC, and that maybe makes me a little biased to the bull side of the thesis. And at some point, we may experience an extended bear market that's going to cause me to start rethinking that approach, where maybe I'm heavily biased towards the short side. In the meantime, on a discretionary basis, the beauty of futures is I can kind of manage the short exposure that I have pretty easily, and even over index on that side fairly easy, just by adding another contract or two that significantly exceeds my current exposure on the long side, and not necessarily be a perfect hedge, right? So I can manage that bias pretty easily through futures.